Well, good afternoon and welcome. This is Brian Tate, the President and CEO of the Innovative Payments Association. We're joined this afternoon with a great guest, and we appreciate him taking the time to be with us and take our questions and have a hopefully thoughtful conversation about everything that's going on over at the OCC. We are joined today by the Acting Comptroller of the Currency, Brian Brooks. We welcome him to the IPA. Thank you for joining us, Mr. Comptroller.
Thanks a million. I really appreciate the opportunity to be here.
You have an extensive resume. I won't walk through every part of it just to give our members a quick sense of your background. But prior to being the Acting Comptroller of the Currency, you were the Deputy Comptroller and COO of the OCC. You were the Chief Legal Officer at Coinbase before that, and you have stops at Fannie Mae, One West Bank, and O'Melveny and Meyer. So again, your background is extensive and touched all parts of the banking world.
Just shows I'm old, Brian. That's all. You live long enough, you have some jobs.
But you look younger than me, so that's for sure. And so we are again pleased to have him here today. And there is a lot to go through, Mr. Comptroller. So thank you. If you don't mind, we can jump right into our questions.
Great, terrific.
Well, it seems that you're here at the OCC at a very interesting and challenging time. When you became the Acting Comptroller, you've set out some clear priorities that have been well discussed in the media. How do you see world events impacting your position and how you might react to them in your current job at the OCC?
Well, you know, I would say, first of all, one of my philosophies in life is that you can never allow the urgent to overtake the important. So there are a lot of things that we do have to get done every day. You know, this is a national, I don't want to say crisis, but it's a national moment on multiple dimensions, and the OCC does have to manage the financial system through that. But at the same time, you know, as I told the agency when I first took the reins as the head of the agency, we got to get to next year safe and sound, but we're also building the financial services sector for the next generation or two. This is an inflection moment in innovation, as you and your members know better than most. And if we don't lay the groundwork for you all to succeed and for us to be able to ensure the safety and soundness of what you all are doing, generations that follow us will really be sorry that we missed the opportunity as the UK, the EU, Singapore, China overtake us in financial modernization. So I do feel like, as important as it is that we get through this current moment together, we've got to build the foundation for the future. This is a unique moment to do that.
With your background in fintech, you know, how does that shape or form your thoughts about the job now? It seems that we're going through this explosive era right now, where there are new products, new ideas that are helping bring more people into the banking system. How does your background help with that?
Well, you know, first of all, it gives me a perspective that fintechs and banks, fintechs and I would say, I guess, traditional banks or legacy banks are a lot less different than most bankers seem to believe. So I always find it interesting when I have these conversations with, you know, bank trade associations, executives of incumbent banks, who feel enormously threatened or feel like it's somehow crazy that we would bring into the national bank charter a payments company or a marketplace lender. But I was on the board of payments companies and marketplace lenders, and I sat in credit committee meetings at the marketplace lender, and it felt just like the credit committee meeting I sat in at the bank. Didn't feel very different to me. And so I don't understand why we think that those unbundled services are any less a bank than those same services would be if bundled together inside of a traditional bank. So I think that perspective definitely helps. What I've also seen is the way that decision-making is made in the innovation space. So if you're a fintech VC or a fintech founder, the way that decisions get made is largely based on your assessment of the inefficiency of the way that exact service is delivered in the traditional banking system. That helps me focus on what aspects of the banking system can be improved, but it also shows me that the banking system would benefit from that kind of thinking and that kind of decision-making, right? It tells us where the risks are and where the service delivery issues are in the incumbent system, and helps us get rid of impediments to making it better.
No, thank you. You know, with someone with your background, running an agency like this and keeping up with it's a hard task, and even for our members who are going through it day to day. So that perspective is welcome. In terms of what we're going through today, all of us, in terms of COVID-19, What is the OCC's approach in terms of helping the industry, helping consumers get through this very tough time?
Well, we've taken a lot of initiatives to try and deliver all of the various kind of rescue packages that Congress has deployed, and to do other things to encourage our bank to work with customers in this period. I could just list off a few of them for you. I mean, one of the easiest to understand is the idea of forbearance on home mortgages, where Congress created a period during which consumers can elect to defer payments on their mortgages until later. And one of the earliest issues we saw was that banks needed to communicate to customers very clearly what those terms were. There were early reports of some customers being told that they'd have to repay the forbearance amount in 3 months, or that there'd be some balloon payment due, or whatever. And so we worked really hard with both bank executives and with some of our fellow regulators to convey the correct message, which is, no, the whole point was we're just taking a several-month pause. Those payments will just occur at the end of the mortgage, so there's not a balloon out there. And I think that really helped a lot of people stay in their homes and stay current on their payments, as a matter of contract, which was great. We also were very active on the delivery of the payroll protection program, the paycheck protection program, I guess I should say, where early on banks were finding it difficult to deliver because it was hard to access the SBA loan platform. It was hard to identify customers and do the KYC work that you have to do to legally, provide those loans to people who weren't already your customers and the like. So we convened a series of interactions between fintech companies and banks to help find workarounds for those challenges and to get the PPP dollars out faster. And I think that was, in the main, a fairly good success. One of the things that allowed the economy to stay afloat over these last 3 or 4 months. So we're very focused on all of those things. But I would say, you asked about COVID. I would say there's obviously another giant elephant in the room, which is the social justice movement, that is currently marching on a lot of our streets in this country. And there, we did not have an obvious toolkit for dealing with that. And yet, I think a lot of us in the banking sector did take seriously some of these protest arguments that there is structural unfairness in the system, like an actual structural impediment, not just that some people have more money than others, but there are structures that keep certain groups of people out. And so with that in mind, we launched Project Reach, which has been this very, very effective gathering of bank CEOs, civil rights leaders, and tech company founders to figure out what are those structures and how do we solve them. And you've probably, Brian, heard me talk about these in other forums, but there's the fact that 45 million Americans don't have a credit score, and yet you can't get a loan without a credit score. That's an example of a structure that is keeping people out, right? And so we're working right now to deliver a new kind of credit score for people who pay their rent on time, pay their utilities, but aren't in the credit system. And once we can give those people credit scores, they will now be eligible for home mortgages, which then makes them eligible for wealth building, right? Which is where most American wealth comes from. We're going to solve that problem. We're also going to revitalize the role that minority deposit institutions play in America and do a lot of other big things to change the structure, right? To show people that markets can work for them if we just tear down those barriers. And that's what I hope will be one of my legacy issues as controller.
If our members wanted to learn more about the REACH program and what you're doing in those efforts, I would assume that is on your website. Is there a place or location they can find that?
If you go to, I think it's occ.gov/reach. Yep. So simple as that. And we would love members' participation. There are a number of important fintechs involved in the project, including Credit Karma and Affirm and others. And so there's definitely a role for people here to participate.
We will definitely follow up with you and your team after today's conversation, but thank you for bringing that up. Speaking of fintechs, even before you arrived, there seemed to be a lot of activity about potentially issuing a fintech charter by the OCC, and that has been tied up in the courts. What is what was and what continues to be the OCC's goal with the fintech charter that was released? How do you see that playing out and the OCC's authority to issue a fintech charter?
So let me start by kind of demystifying something, because I think over the last 5 years, we maybe have not done a great job of communicating really what we're trying to do. So forget the phrase fintech charter. Let's pretend like nobody ever talked about a fintech charter. What we do here at the OCC is we issue bank charters. And to be a bank, you have to do an activity that's permissible to banks. The core activities that are permissible to banks are deposit taking, lending, and payment processing. Those are the core activities. The point that we have is we don't understand why you would have to do all of those activities to be a bank. We think that if you do any of those activities, you can be a bank. And the problem and not a narrow bank, but a real bank, right? So we're not suggesting that this is a new charter type or anything else. We're just suggesting that these companies qualify for the existing national bank charter by virtue of the financial activity that they're engaged in, which historically has been done inside of banks. Here's the way I look at it. If you went back 10 years, 100% of payments activity in the United States occurred inside of banks, right? The only companies with access to the Fed's payment rails were banks, and all payment processing occurred in banks. And then the fintech revolution started, right? In the early 2000 teens, PayPal was founded, Stripe was founded, Square was founded, a series of other companies. And they took this activity that had always been done inside of banks, and they said, you know, maybe we can do this a little bit better and a little bit more profitably. And they took that business away from banks and put it on a standalone platform. My question is, if that was always a banking activity, why is it not still a banking activity? There's no magic that says it's only a banking activity if it's coupled with deposits. It's always been done in banks. Most of that activity still occurs in banks. I just want to create a platform that allows us to continue to supervise that important activity inside the banking system. And it's hard to understand how anybody could argue that it's better that it remain unsupervised. That's my
That's a great answer. And I do want to I would assume that part of this extends to a lot of what we've read about recently to a potential payments charter that might be coming down the line at some point in the future. Can you talk a little bit about that as well?
Yeah, absolutely. So look, one of the reasons I say forget about the fintech charter is these are all the same charter. They're all the same charter that JP Morgan has. The question just is, what do you have to do to be eligible for that charter? So if you're a marketplace lender that doesn't take deposits, our view is you're eligible for a national bank charter. If you're a payment processor that doesn't engage in lending or take deposits, our view is you're eligible for a national banking charter because the activity that you're doing is a historically bank-focused business. You're doing it on a standalone basis in a specialty firm, but it's the same thing. I mean, the analogy I was giving somebody earlier today is, let's say you want to buy a pair of jeans in this country. You know, you could buy them at the Macy's, or you could go to the Levi's store. One is a department store with a lot of other stuff going on. One only sells jeans. They're still the same jeans. Nothing about the Levi's store changes the underlying nature of the product, right? To me, that's not a bad analogy. So the payments charter and the marketplace lending charter are the same thing. They're just companies that don't take deposits, but are engaged in a core financial activity.
Well, I'm glad you brought it up in the marketplace lending. You've touched on it a couple of times in your responses. You finalized the rule. One of the first acts you took was to finalize the valid when made rule. What's the OCC's goal with finalizing that rule? What do you hope to accomplish?
Well, what I'm trying to accomplish here is to have more credit availability for more people. And the way that the marketplace lending sort of environment works is marketplace lenders typically partner with banks such that a bank might originate a loan and the marketplace lender will buy that loan from the bank and will hold it for investment, or maybe we'll securitize it. That has the effect of freeing up the bank's balance sheet to make the next loan and the next loan and the next loan after that. Maybe the most common analogy people are familiar with are Fannie Mae and Freddie Mac, right? So banks will make a mortgage and then sell them to Fannie Mae, which then has the sort of effect of allowing the bank to make the next mortgage loan. If we don't have those marketplace lending arrangements, however, then the binding constraint on the amount of credit available in the economy is the size of the bank's balance sheet. And once the bank has lent the last dollar, there are no more dollars left to be lent, right? Until the loans get repaid. Turns out bank balance sheets are only about 20% of the total amount of credit in the economy. So if we couldn't have marketplace lending arrangements, there'd be a lot less credit. And who do you think would be cut off from credit first? Quick quiz. It wouldn't be me. It would be poor people. It would be predominantly minorities. We would have effects that would be very negative. So the point of the Madden fix rule, the valid when made rule, is to make it easier for banks and marketplace lenders to partner together to continue to supply credit to these communities that otherwise wouldn't have the credit available. It's another reason why we just last week put out our true lender rule to make, the sort of the final point that banks, are the true lender in a certain set of circumstances. And when they are, they're responsible for ensuring fair lending compliance and disclosures and consumer protection rules generally. So that's very, very clear that we will not tolerate rent charter arrangements, but we do want to encourage banks to leverage their balance sheet through these kind of partnerships. We think it's good for a lot of people.
You brought it up. You keep beating me to the punch here. So the true lender rule proposal and how these two work together, the ballot when made in true lender, and there are issues of that have been reported about potential predatory lending. Can you talk a little bit about those?
Yeah, well, this is one of those things where I often say that, the use of a pejorative adjective like predatory often masks an underlying lack of content. So we should first define our terms, like what is a predatory loan? Everybody understands that the law allows a bank to make a loan anywhere in the United States at an interest rate that is legal in the bank's home state. That's been the law since the 70s, and I think everybody knows that. So nobody thinks that when a bank makes a loan from its location in South Dakota to a customer in New York, that loan's predatory. It was clearly legal, and for good reasons, by the way. The question is, does that loan, with that loan's terms, become predatory because somebody else later buys the loan? So the way I put it is, if you take out a mortgage at 4% and you've agreed to it and that's the legal rate, do you care that the current investor of your loan is Fannie Mae versus Bank of America, or that the investor of your loan is some private securitization versus Bank of America? Of course you don't. You took out the loan in the first place and nothing about the loan has changed. And so the notion that it's opening up the world of predatory lending, it just means banks will be able to make more loans at a rate that was legal at the time it was made. So to me, that word is just a pejorative adjective. It doesn't really tell you very much. What we should be concerned about, though, as I said a minute ago, is this concept of rent-a-charter, which again has not been well defined, but in our true lender rule, we define it. So what we say in our true lender rule is, if a bank is engaging in these partnerships, which we think is great, it cannot just wash its hands of all responsibility for that loan. If the bank's making the loan in this partnership, it must ensure compliance with all of the relevant consumer protection laws. That's how we prevent rent-a-charter and make sure that somebody's accountable for that loan. And that's, I think, a huge unsung problem that we've solved.
Can you tie all of these things together, just go a tiny bit deeper and talk about the benefits of all these new rules to consumers?
Yeah, so there have been studies that have shown in different states. There was one that was done in Colorado relatively recently, which show that if you have a market where the only available credit is from national banks. So let's say you have a state that has a relatively low usury threshold, meaning that you cannot legally charge above a relatively low interest rate for loans. That's essentially a price control, right? And price controls usually create shortages. So in an environment where there's a low usury cap, most of the credit that's going to be supplied in that state is going to come from a national bank, because national banks can avoid usury caps using their legal interest rate powers. If the only credit that the bank could extend was on its own balance sheet, again, banks only have so big of balance sheets. And so that means that the credit very quickly dries up. The first dollars of credit are extended to the most creditworthy, safest people, which tend to be the rich people and the big companies. And when the bank's balance sheet is exhausted, there's no credit left. And so what poor people then have to do, people down the credit spectrum have to do, is they have to go to payday lenders, hard money lenders, and other kinds of institutions that will be, a less attractive option for them if it's available at all. What the Colorado study found was that both pricing and credit availability were better in an environment where there was this marketplace lending partnership than in the pre-partnership days, right? And so it meant that people who had been paying crazy rates at the payday lender got a better deal. Now, the argument on the other side tends to be, hey, if somebody's going to pay a higher rate than the usury rate, it'd be better if they not get that loan at all. That's what people tend to say. We should have an interest rate cap, and above that, there should not be any credit. The problem with that is the people who make those arguments tend to be the elites. They're the people who've already made the money and are now working in the think tank writing these academic papers, and they're not people who've ever had their water heater blow up and not be able to afford a new one. And so, coming from a blue-collar background myself, coming from a steel mill town and knowing people who had been in that environment, I don't take the elite view. I understand that people in this country come in all shapes and sizes and all different wealth backgrounds, and I don't judge the fact that they need those kinds of credits. I keep in mind that payday lenders currently serve like 19 million people in this country, and those people are not doing it because they're being duped. They're doing it because they need the credit. I'd rather have banks supply it than not. Kind of as simple as that.
Well, that opens the door to another issue I wanted to touch on, which is small dollar lending. The OCC with the other prudential banking regulators put out some guidance recently on small dollar lending. What can be done from the OCC standpoint? What more can be done from the OCC standpoint? And what might the industry or innovation be able to do to help you?
Yeah, well, I mean, so the first thing to do is to eliminate the regulatory uncertainty about small dollar lending, which, as you point out, we've now done. It's historically been disappointing that bank uptake of that product hasn't been higher, but I expect now the guidance is out there that we'll see more of that. But the other thing we can do is to make the world safe again for these partnerships. So, most banks have relatively high cost structures. Their employees are relatively high compensated employees, and it costs money to originate every dollar of credit. So it's more efficient that a given bank employee is originating a big loan than a small loan. But these marketplace lenders' entire business is making small consumer loans to people who are, taking out sort of short-term 6 to 12 month. The way for banks, I think, to access that at the end of the day is in part through these partnerships. So it really does all come back to all of these issues are related to each other. Small dollar lending, True Lender, and the Madden Fix all are part of an ecosystem that fit together, I think.
And I do want to ask you one more question before we've received a question or two in our chat room, so I hope we can get to that in a second. But I do want to touch on one more thing. Last week, the OCC released an interpretive letter on crypto and wanted to give you an opportunity to give some more context and color in terms of urging banks or recommending that banks can use or provide custody services to crypto assets.
Sure. Well, if you sit where I sit, crypto starts to look a little bit like Uber. And what I mean by that is there was a time when people were really, really worried about Uber. It probably wasn't going to be safe. What would happen if you got in a stranger's back seat? Bad things would happen. And so a lot of governments around the country, a lot of municipal governments tried to keep Uber out, Except over time, millions upon millions of people decided they really liked Uber. And notwithstanding what their local governments wanted to protect them from, they really demanded it. And so opposition to Uber went away, right? Remember the time that Ubers couldn't come to the airport or Ubers couldn't stop to have it? Those days are over because people want it. Crypto is the same thing. People above a certain age sort of assume that crypto is about criminals and cyber hackers and other kinds of things. And they assume it's some weird niche thing, but the true facts are that like Uber, there are 40 million Americans who use this stuff. Like roughly 40 million Americans are crypto investors. And so it's not really possible for the banking system to ignore that fact. These people hold financial assets. Banks custody most of the financial assets in the United States. And so we had gotten a question from a number of our banks about, well, gee, since we custody sort of electronic securities and we custody antique automobiles and we custody fine art and stock certificates, can we also custody the private keys for crypto accounts? And, we looked at that. We looked at all of the custody precedents out there, and we couldn't find a reason why they can't do that. And since part of my job is to make sure that the banking system is fairly serving all Americans, and like 12% of Americans own this stuff, it only made sense that we would, extend the custody power to include these assets, like it already includes a lot of other assets. Now, there are a lot of other dimensions to crypto that we'll be looking at over time, but custody was a fairly straightforward and easy call, I think, under our precedents.
Well, as I mentioned, we've started to get one or two questions. Hopefully you have time to take those if that's okay.
Of course, absolutely.
Our first question is, and this is something that's gotten a lot of attention recently in Congress, is the digital dollar. What are your thoughts about that conversations that's starting to happen right now?
Well, not surprisingly, given my prior job, I've thought a lot about the digital dollar and what that really means. There are sort of two basic models when people talk about the digital dollar. There's, what people refer to as a central bank digital currency. In other words, like the Fed would create some sort of digitized or tokenized dollar and would issue that as part of their M1 activities, which is one point of view. And then there's my point of view, which is actually the digital dollar is more like a telecommunications app. I'll tell you what I mean by that. In the same way that I'll put it like this. A digital dollar, if it works well, will be a dollar. It will be worth a dollar, but it will have other features attached to it. It will be programmable. It will be instantaneous. It will be fungible with fiat dollars. It'll have all of these things that go beyond what dollars do. The problem is different users of digital dollars are going to care about different features. So think about all of the communication apps that are on your cell phone, right? You probably have an email icon. You probably have an SMS text messaging app. You might have WhatsApp. I've got Signal. You know, there are all kinds of different apps that we use, Facebook Messenger. And we use different apps for different purposes. Like we probably use an email if we want to send somebody a video, but we might use a text message if we want something quickly. Or we use Signal if we want privacy, right? They all have different features. I think it's going to be the same thing about money. People are going to want to transmit money in different circumstances using different features. And so my view is the role of the government shouldn't be to build the token. I think the role of government is to establish the audit standards, the collateral standards, the disclosure standards, the redemption standards, but then let industry decide what the market wants. That's why we have all these cool things on our phones, is because the FCC didn't go and build one communications app for America. It just said, as long as you comply with these rules, you can build whatever the heck you want, and then we serve markets. So that model is focused on sort of stable coins, where private companies develop stable coins that have different features. And right now we've got multiple stable coins with more than $500 million of market cap, because it turns out some people want Tether and some people want USDC and some people want other things. So I'm always going to go the route of government sets rules and frameworks, private industry invents things. That's what's made America great, you know, in the last century. And I hope we don't lose sight of that fact when we move into the next.
Oh, thank you. That was a pretty thorough answer there. In terms of conversations that's just getting underway here. We do have some other questions in terms of circling back to low risk borrowers. Has anyone proposed the option of high dollar, low risk borrowers opting to subsidize small dollar, high risk borrowers? Is that an issue that is kicked around?
Well, I guess I would argue that's what the banking system is, right? I mean, so rich people have big deposits, which are artificially low cost sources of funds for banks, who then use that money to lend out to people who need to borrow. So, you know, mostly wealthier people are net savers and poorer people might be net borrowers. That's exactly what you're talking about. That's the wealth transfer from the rich to the poor. I would also say there are all of these really interesting sort of peer-to-peer platforms. I was just hearing about one last night at dinner that is specifically focused on the kind of scenario you're talking about, where the platform has an interest rate cap. So nobody can ask to charge more than, I think the person said 10%, which is awfully low. But the idea is there may be people out there who are willing to lend out money at a relatively low rate of interest to a stranger they don't know who's in need. So I think peer-to-peer lending marketplaces are an example of where that happens too. But I just come back to the core banking system is people who are net borrowers are delivering cheap credit to or people who are net savers rather are delivering that to net borrowers.
Our next question is on the issue of open banking. And the question is, will the US place more regulatory constraints and standards amongst data aggregators partnering with banks?
I would say that like that's an important issue, obviously, and we already have a set of third-party risk management guidance that affects the way that banks can partner with those kinds of companies, the Plaids and the Blends and others of the world. Having said that, I would say the benefits of those features are really, truly substantial. And so I don't want to come off as suggesting that I'm focused only on the risk side of that. I mean, those kinds of firms, among other things, cut significant amounts of time off the mortgage application cycle. They make it way easier for people to get direct observation of credit performance, which can be a substitute for FICO scores, you know, which I was talking about earlier as such a problem. So, you know, I personally am a big fan of those kinds of companies. But having said that, you know, we've looked at them, we've given third-party risk management guidance, and we'll obviously look at them more over time. But I think at the moment, they're a net positive for the system.
Well, those are all the questions we have. I do want to just pause, see if anyone else in our membership who's attending has a question for the Acting Comptroller, who's been a wonderful sport in taking questions from all corners. Well, at this time, Mr. Comptroller, I do want to thank you. Appreciate you taking time out of your busy schedule. We appreciate everything you're doing to help people through this very difficult time. And we look forward, if we can, to get you back before the end of the year, if that might be possible as a follow-up. There is a lot moving in the payment space, and we might be in a completely different place in 5-6 months from now. So we hope we can bring you back.
That'd be great. Listen, thanks so much for having me. It was a real pleasure.
Thank you, Mr. Comptroller. Enjoy your afternoon.
You do the same. Take care.